And if anybody wants to pass it on to anybody else, they're free to do so. We might email you a short feedback form afterwards just to get your feedback on how we can improve these webinars. And just a reminder that the content of this webinar is formal financial advice. So the first thing at a very high level is, you know, what do we need financial protection for? So when I was coming up with the presentation, I said we break it into 3 different timelines. The first timeline is everything up to now, and ultimately that's your asset base or your capital that's there already, both your financial capital, like the value of your assets, but also your intellectual capital and your earnings potential. So protecting what you have and insulating yourself as much as possible from any downside risk is very important. The next level really, I suppose, is looking forward from here for the rest of your lifetime and making sure that any future growth in your assets or your income are also protected. And then the last stage is after you're gone and the next generation, if relevant, to make sure that you have a legacy for them. And I suppose that is an intergenerational risk, that the assets that may have been built up by one generation aren't successfully passed on to the next. This is a crude kind of graphic, but it does categorize people into 4 different groups. And you've got, you know, wealthy, and then you've got the second one, doing okay. Third one is people financially struggling, and then the fourth are poor people. And regardless of where an individual or family sit on this, there's always the opportunity to go up a level or 2. But when you're at a level, I suppose it's very important to know that nothing is forever, and market conditions, economic conditions, but most often than not, poor financial decisions can move somebody, say, from being in the wealthy bracket down to level 2 or even level 3. We obviously saw that in 2008 and 2009 in Ireland, and we may see it again as a result of COVID. But I think this is just a very clear way of just illustrating the different brackets that people can be in, and to make sure that you know where you are, both based on your income levels, your cash flows and your capital, and making sure that you remain where you want to be in terms of this. So the first area we're going to look at is asset management risk reduction. So what are the risks to assets? Well, the first is that if your assets are invested, and when I say invested, I mean anything other than cash, then there's a risk of the capital value falling. And that includes government bonds, corporate bonds, the seemingly safe assets. Sometimes people buy a residential property, even with no loan, and they have a 4 or 5% income yield, and they feel as though, well, the income is secure, but there obviously is a risk that the capital value of your properties will reduce in value over the short to medium term. If you put all your assets into cash and they remain uninvested, well, there actually is a risk to that as well, because what we're seeing at the moment is that with interest rates at 0 and potentially going negative, there is actually a risk that, you know, you lose some small element of value, but also that inflation, the rate of inflation, is higher than the level of growth in your cash. So over the long term, there's a risk that you'd lose the purchasing power. So either way, whether you're conservatively invested or invested from a risky point of view, there is always going to be some element of risk. Okay, so how do we protect our assets? The first one is diversification, and this is something that people are very familiar with, the term diversification. What it really means is that it's spreading your asset exposure to reduce your concentration into one particular asset class. So the pie chart here kind of shows just a sample portfolio, and it's really just to illustrate the different color schemes and the 6 different main asset classes that could populate a portfolio. But the idea is to pick asset classes that are not correlated historically with the performance of other asset classes. So that really is a bit of a no-brainer in terms of reducing risk. And ultimately, the more pieces of the pie, the more diversified a portfolio. And diversification is across both asset classes, but also geographies, sectors, management style, liquidity profiles. So this pie chart just shows high-level asset classes, but a more sophisticated portfolio that's diversified would be diversified across a broad range of different aspects. Okay, the second tip, and this is a bit of a mouthful, okay, avoid the chance of losing a disproportionate amount of your wealth on one investment. So I don't think there's any better way of shortening that, but really it's just saying that if you can avoid a large amount of your assets in the individual shares, okay, that's individual stocks or even individual sectors within the equity market, then you've actually removed a fairly big potential downside risk. So rather than putting all your money into bank shares, as we saw in 2008, 2009, airline stocks, one particular utilities company or whatever it might be, or technology company, spreading across individual shares or sectors will reduce the risk. And also avoiding putting too much capital or sometimes any capital into syndicated deals that represent a large portion of your assets that you don't have control over, because unfortunately over the years people have lost all of the money in these deals. You know, the typical deal that might be 65% leveraged by a bank, so if there's any bit of a drop in the capital value, then the bank might impose a loan to value covenant, which can wipe it out completely. So the idea is that if you invest your capital in collective investment structures like funds, ETFs, that type of thing, you are actually reducing your risk. Now, you are minimizing your upside potential because you're not going to put all your money into Apple shares that might triple in value, but you are really, really importantly reducing your risk. An obvious one is keeping a level of cash on deposit at all times. So that's very important. Even if our cash rates are at zero or negative, having some funds in cash is very important, both as a rainy day fund, but also as a portfolio diversifier. So when I meet a new client, and if they tell me they've already got cash put away in on post or in an account that's inaccessible to them, it enables them to take more risk with the non-cash element of their portfolio. So having a cash buffer is very, very important. The amount you have is completely tailored to your circumstances, and that would be a one-on-one conversation with us to talk you through that. Avoiding leverage. I think first-time buyers have to take out a home loan mortgage. People switching mortgages, you know, it's very important to have debt at some stage of your life when you're trying to build a home or buy a home for your family. But for investment purposes, there's genuinely no need. You're really, really compounding the risk. When you put debt into investment returns, it really does exacerbate the risk and means that, as I gave an example of the syndicated property investment, you can wipe out your assets completely. The next tip is only invest funds that have a 5-year plus time horizon. Okay, so very, very important. It's time in the market, not timing the market. Okay, so obviously markets are very volatile at the moment, but if you're making an investment decision for, say, 12 months, if you said, I might want to take the money back in 12 months' time, it's going to be extremely difficult to predict which way markets are going to go over the next 3, 6, 9, 12 months. But the longer time horizon, which comes to the second bullet point here, the longer the investment time horizon, the lower the impact proportionally that this short-term market volatility has. And ultimately, the greater your chances of outperforming the risk-free rate of return. The risk-free rate of return is what you get by putting your money in a current account in the bank. So the longer your investment time horizon, the better the chances you have of outperforming and the lower your risk ultimately. This is a chart of the 8 major stock market indexes year to date. Now, if you look at when COVID hit Europe, or Italy mainly at the back end of February, we saw a 40% drop in Europe, 40, and 1/3 of the value of the S&P was wiped off in 4 weeks, okay? So if you had a short-term investment horizon and you invested in the early or mid-February, you'll be looking at losses of up to 40% in a 4-week time. Now, there has been a bit of a recovery so far, or since the back end of March. I'm going to show you the exact same chart now, or the same 8 indices, but over 10 years. So before I go on to the next slide, just remember how steep this sell-off was in the 4 weeks from the end of March. And now you'll see over the 10-year period, it matters a lot less significantly than it does, say, over a 9-month period that we looked at. So historically, stock markets will increase in value, but you need to have the long-term investment time horizon. This is just a simple chart showing risk and return. So at the bottom left here, bottom left corner, you've got traditionally cash deposits, low risk, low return. And the further out the curve you go, for the more risk you get, you take on, the more the expected return. So there's nothing worse than someone saying, I want to achieve 10% returns with no risk. It doesn't actually exist. So understanding what your investment objectives are and your risk profile is very important when designing your portfolio. The next slide, and I showed this in a recent webinar we had as well, just shows how this risk return chart is a bit distorted at the moment, because in this slide, you'll see down the bottom left corner, cash and bonds have gone slightly negative and there's still an element of risk there. So there's a bit of a vacuum at the moment in terms of what's going to give you the low to medium type of investment return because of what's happened with bond yields. So that's just something to be conscious of. So when investment firms are advertising at the moment, scaremongering, telling people to look at their investment options because deposit rates are low, just remember there is no such thing as no risk with a target return. It's literally impossible. Okay, so before you commit to anything else like that, please do talk to me, because the worst thing is for someone to say, well, I'm not getting any rate of return on deposits or bonds, so therefore I'm going to invest in equities. You should only invest in equities if your risk profile tells you you have capacity for that, not just if your cash deposit return is zero. The level of risk depends on your age profile, your personal risk profiles, the entirety of your assets, and also what your own view on markets are. So your risk for your portfolio is going to be different to everybody else, and that's where bespoke planning comes in. More risk simply means you've more exposure to risk assets like equities and property, and less to the likes of bonds and cash. So the next area I'm going to go on to is protecting you and your dependents. So we've spoken about protecting your capital as much as possible. Now we're going to speak about protecting you and your dependents. So it's mandatory in Ireland to insure, say, an investment property and your car. You can't drive without insurance. Insuring, I suppose, yourself and your dependents, your financial dependents, which may be a spouse and children, if they're below the age of 22 usually, that's very important. So there's 3 main risks. Okay, the risk is that you die and your financial dependents, children and maybe spouse or partner, are left financially destitute after you're gone. Another risk is that you're no longer able to work. So somebody who's receiving a fairly large amount of either employment income or self-employed income, if they got struck by a car or long-term illness, cancer, whatever it might be, there's obviously going to be a significant hit to your future earnings. So that needs to be protected. And also, if anything did happen to you, to anybody who has significant income coming in, well, that oftentimes we see the lifestyle that your family have signed up to and have hoped for, and it goes back to the 4 chart we showed earlier with the different levels of wealth. The future lifestyle is going to be massively impaired, because if the breadwinner, for want of a better word, is no longer in a position to earn money, then there's a significant risk there. So I suppose the best way to describe protection policies is what type of life insurance or insurance can you take out to protect against those 3 risks, okay? The first one is life insurance, which is very simple. It just pays out on death. Anybody here who's taken out a mortgage will have taken out a mortgage protection policy. And anybody who's worked for big companies usually will have what they call death in service in place, which might be 4 times your salary. So that's a very, very important stable. Self-employed people who don't work for big companies may not have death in service, or most likely won't have death in service. And oftentimes people who took out a mortgage, paid it off, or that was many years ago, their mortgage protection policy would be gone now anyway. So it's very important to find out how much life insurance you have already. A serious illness policy is a type of policy that just pays out a lump sum in the event of the insured being diagnosed with a certain illness. So if I get cancer or if I get a heart disease, a lump sum, let's say 50 grand gets paid out. And then income protection is similar to serious illness in that you don't have to die to get it, but income protection is a monthly income that you get, and it's something that I personally prefer for clients. A lot of the self-employed and even PAYE workers don't have income protection, and it's very, very important in order to mitigate the risk of you being unable to work and your salary going to ultimately to zero. And as we know, the social welfare benefit is about 12,000 per annum. It's nowhere near significant enough. Okay, so does everybody need life insurance or protection? Of course not. It's only relevant for some people. If somebody doesn't drive a car, they don't need car insurance. So this isn't a sell, by the way. There's certain people who probably should never have taken out life insurance and don't need it anymore, whereas other people it's a lot more important for. So who doesn't need life insurance? Well, if somebody's retired, they have wealth built up and they have income coming in, say in the form of pension income. And if their financial dependents are no longer financially dependent on them because they're adults and they've left the nest as such, then they don't need life insurance unless it's for inheritance tax, which is Section 72, which I'm going to touch on later on. So ultimately, there is no insurable interest with that person, because ultimately, if anything did happen to them, if they did pass away, there's no big debt to be repaid. There's nobody that would be financially destitute in the event of them passing. Somebody who is the other end of the spectrum, who's young and is single, unmarried, has no children, has no loans, they don't necessarily need life insurance either. They might just need income protection against their income, and it might only be a very small amount of income protection. However, people who do need financial protection is somebody probably my age, similar to me, running their own business in their 30s or 40s with young children who are financially dependent on that person. So for them not to have life insurance or income protection is absolute madness. So somebody who's 40 years of age could have 20 or 30 years of future earnings potential ahead of them. They need to have income protection for sure to mitigate the risk of anything happening to them and their future earnings being lost completely. So it is important with life insurance. There's a lot of people in this call are clients of mine, they're retired, they don't need life insurance unless it's Section 72. But for young professionals, business owners in particular, life insurance and protection is very, very important. Okay, so the next section is retirement and longevity risk. Okay, now this sounds a bit counterintuitive because we all want to live longer. So if you don't have a defined benefit pension, so if you haven't worked, say, in the public service or the civil service, you won't have a defined benefit pension. So there are financial risks in that once somebody retires from work, their earnings, their employment or self-employment earnings will either cease or reduce. They might stay on to some extent with consulting or whatever it is, but generally speaking, earnings will cease or reduce. And there's also cost of living and inflation. So some people spend more in retirement. We're not seeing inflation over the last few years, but believe you me, with all this QE and money governments are injecting into the economy, there will be inflation in a couple of years. There has to be. So one can expect the cost of living to increase by, I use about 2 or 3% every year, which if you compound that over 10, 15, 20 years, adds up to a significant amount. And the state pension simply isn't sufficient enough. So the key to successful retirement planning, you need to make sure you have a cash flow analysis done to ensure that you have enough funds for your retirement. And this isn't just for somebody who's 60 today. or 65 today who's looking to retire. This is for people who are in their 70s, but also people in their 30s or 40s who are planning pension contributions now for their retirement. They need to make sure that they have enough money for themselves first and foremost. Those funds that are ring-fenced themselves, they can then ring-fence surplus funds on for the next generation. So as part of succession planning, it's ring-fencing more of your funds that you do not need in your lifetime, you or your spouse, that can be passed on to the next generation. And with that surplus capital, more long-term financial decisions can be made. So somebody who's 65 years of age, you could say, well, they should be conservative in their risk profile because they don't have 50 years to make back returns if there's short-term volatility. But if you were able to say, well, there's X amount of capital now that's definitely not going to be used by them in their lifetime, then you can actually take a longer-term investment view and look at things like trust accounts for kids and all that type of thing that we'll talk about in a minute. So for long-term financial planning, again, this is all about risk reduction. Always have a long-term investment time horizon appropriate. Use tax-efficient options, which is pensions ultimately, and be proactive. We get so many of our clients coming to us when they're between the age of 56, 57 and 65, and they're only looking at things now for the first time. Well, people should, from 40 onwards, 35, 40 onwards, be making financial decisions now so that they won't be in trouble when they're in their 60s, that there's unbelievable tax reliefs available through pensions that people can start providing now, or into educational funds for their own small kids, so that when they get to college, they're not all of a sudden being hit with a bill of 20 grand per annum or 25,000 per annum for each of their 2 or 3 kids, that they've actually set up a fund 10 years previously to fund that cost. So previously, I really like this chart. It just shows that as a percentage of your life before your retired years were only, maybe 20, 25%, whereas now people are spending almost as long retired as they had been working. People who are looking to retire at 60 or 60, 62, 63, 64 could potentially live until 90. So you're looking at 20 or 25 years of extra spending in retirement with no income. So if you really, really think about that, if you retire at 60, you can have 30 years of spending and no earning to fund. Even if you retire at 65, you're looking at 25 years. So it just shows the importance of financial planning. And cost of living can increase in retirement due to healthcare needs and helping out children financially and all that. And as I mentioned earlier, there is a big not lack of state support. There is a state pension, contributory and non-contributory, but it's only 13,000 per annum. So if somebody's used to spending or receiving an income of a couple of $100 grand a year, then obviously 13,000 is appreciated by anybody who's received the state pension, but it doesn't go far enough really. So that's why private pension provision becomes more important. So if someone's retired at 60, you're looking at 30 years of living with no earned income and higher costs of retirement. So people say to me, how much to reduce my risk? How much of a pension do a couple need to build up? Well, the rule of thumb I use is multiply your income need by 20. So if a couple want to have 120,000 gross pre-tax income, they need to have about a 2.4 million pension pot. That's just thereabouts. And that's before you provide for children or grandchildren. So again, it just shows the importance of pension investing in the context of tax relief. With pensions, you ultimately contribute less than a personal investment. So if you're putting 1.5 million into something over your lifetime, well, if you put it into a pension, it only costs you 900,000 because the revenue would give you 600,000 by way of tax relief. All else being equal, we're buying properties at the moment for a few clients in self-administered pensions, which is a great option if someone is that way inclined. And if you think of the rental yield, typical property, you buy it for 400,000 and there's 20 grand a year rent, call it, after maybe management fees. That 20,000 is taxed at 52% for a lot of people. The rental income is, whereas if it's bought in a pension, that's tax-free. There's no capital gains tax in a pension, no exit tax, nothing like that. So all else being equal, a pension will grow 30% faster than a non-pension. So prioritizing pension is very important for reducing your retirement risk. So succession planning, we had a very successful webinar a couple of months ago with John Gill of Matheson. I think John is on this call actually, so there's more detail in that. So if anybody wants a recording of that, do email me afterwards. But just to go through at a high level, why have a succession plan in place? But very simple, you want to ensure that your stated wishes on the distribution of your assets are met. Anybody on the call here who's below the age of 50, don't switch off. This is just as relevant to you. It's not just for people above the age of 65 or 70. You know, you need to think about your succession planning at all time. It's really, really important in financial planning. You also want to reduce capital taxes as much as possible. And you want to generally assist your children or grandchildren financially and pass on a legacy. So one of the non-financial risks out there, everything I've spoken about so far, you can put into a spreadsheet and quantify, but behavioural risks, and this is just based on feedback I have from clients of mine who've children and grandchildren. So, you know, most people in this country who've built up wealth have done it through hard work and perseverance and that type of thing. So the fear is that the next generation may not appreciate that level of hard work if they were just handed a check. They may lose respect for their own career development. They may squander the funds. So they might decide, well, I'm not going to continue with my third level education. I'm going to just spend this money and buy a new car or whatever it is. So that's a big fear and a correct fear, I might say, that people would have for children or grandchildren. And oftentimes they just may not have the maturity or the mental capacity to manage wealth. I honestly reckon somebody isn't in a position to manage an inheritance until they're about 30. So, so managing that is very, very important. How to mitigate these risks? Okay, so involving beneficiaries earlier. So if there's an estate that is worth a significant amount, and if children or grandchildren are going to get it anyway, well, you can put your head in the sand and wait for the probate to come through and for them to get a surprise check after capital taxes, or you can involve them early and get them involved in the process. Assigning conditions on asset passing. So one way of doing that is, you know, we see with the central bank rules at the moment, it's very difficult for even high earning people in their 20s to buy their first home, where you should say, well, I'll gift you 100,000 on condition that you take out a mortgage of X and don't spend more than Y on buying a property. Or on condition that you graduate from college or you work 5 years for one of the big four or something like that. Passing illiquid assets or assisting with buying a home rather than cash. So rather than just transferring money to their account, in terms of 3,000 a year small gift exemption, all that, you can do that in a way where they don't have ready access to it. And psychologically, there's a big difference in my experience. And trust and family partnerships. So again, if you want to hear more about them, we'll send you on the link to the Matheson webinar we had a few months ago. So how much can be passed on to the next generation tax-free? So a lot of people aren't sure of this because it's changed so many times in the last 10 years. So every beneficiary is put in 3 categories. The first category is called Group A, which is the child of the disponer. The disponer is the person giving the gift or the inheritance. And that's 335,000 at the moment. A couple of years ago, it had been intended by the government to move that up towards about 500,000, but there's not a chance of that happening now with all these COVID payments. Group B is generally a grandchild, a sibling, or nephew, niece, and that's 32,500. And Group C is basically a stranger in blood, so anybody who's not a direct Group A or Group B beneficiary. So how is the euro value of a non-cash asset valued? We got asked this question last week, so I just thought I'd put it in here. So it's easy to value cash. Obviously, it's easy to value listed assets like shares because there's a market value. Illiquid assets like property and business interests, they're ultimately valued at the time of the inheritance of the gift or whatever it is. So it's less clear cut, but revenue, I know we're looking at that a lot more closely at the moment to make sure that the value is correct, and it's more subjective. So the other thing a lot of people are wondering about is what's the difference between a gift and an inheritance. A gift is something that's passed on in the lifetime, in your lifetime, whereas an inheritance is on death only. But the same capital tax rate is 33%. And these are collectively known as capital taxes. So if a beneficiary receives some gifts or inheritance, but less than the threshold, well, they don't have to pay tax on it. But if it's more than 80%, they do have to report it to revenue. Again, Compass don't provide tax advice or do tax returns. So you'd have to just tell your accountant or tax advisor if any of your children or if you have received a gift more than 80% of the threshold. And equally, the group, say Group A, which is parent to child, that's 335,000 in total from the mother and the father. Just like Group B, sibling, 32,500. You can't get 32,500 from 3 different siblings. It's 32,500 in total from that class of donor. How to minimize 33% capital taxes. Section 72 whole of life policy can be extremely relevant and appropriate. There are a lot of conditions with that. Ultimately, it's a life insurance policy that's whole of life that pays 33% inheritance tax. It's only relevant for those whose assets, their net assets, are greater than the sum of the tax-free thresholds for the kids. So if somebody had 7 children, they actually have 7 335,000 thresholds, whereas somebody with 1 child will only have 1 335,000 threshold, if that makes sense. Somebody with no children won't have any threshold, so potentially something like this would be a bit more relevant also for them, in accordance with their will, obviously. Section 73 policy, I won't go into this now in detail, but it's a really, really clever savings policy to reduce gift tax, lifetime gift tax. Also putting growth of your assets into names of your children, potentially through a family partnership. That's fairly bespoke, sophisticated planning. Again, talk to me offline about that. The small gift exemption, 3,000 per annum seems like very little, but when you actually count it up, it's significant if there's a lot of beneficiaries. If a beneficiary is under 18, they can't legally own assets. That's why you set up a bare trust that holds a fund until he or she is 18. There is a risk that when they're 18, it's legally their money. So you want to make sure that's managed from a behavioural point of view. So a couple with 3 children who are all happily married, and then with 6 grandchildren below that, that's ultimately 12 descendants above the husband and wife up the very top. So those 12 can receive 6,000, 3,000 each from granny and granddad as such. So 72,000 per annum can be gifted on to the next generation. So that's a significant amount. I don't like the idea of just writing a check on the December 31st every year and for 6,000, just giving it to someone. We actually set up investment policies for each of the beneficiaries, and the money goes in there and it gets invested, and it's kind of locked away, so it's not accessible to them, so it doesn't affect them from a behavioural point of view. Writing a will, very important to reduce risk. It sets out how your assets are to be distributed on your demise. A lot of people feel as though, well, I write a will now and that's it. The solicitor has it, I never have to look at it again. I think the opposite. I think you need to review your will every year or two. And as you get older, closer, beyond 70, 75, updating a will becomes more relevant. But also for people on this call in their 40s, 50s, it is extremely important to have a will on file. Most married people, it's very simple, each to the other, but really sometimes when you put a bit of planning into it, somebody might have a sibling they want to look after, somebody might have certain wishes on what to do with the assets, they can do that through a letter of wishes. So again, we don't provide legal advice, but going to your solicitor or finding a good solicitor ultimately to help you write the will is very, very important because it needs to be bespoke to you. Having an enduring power of attorney is very important. What that is if you lose mental capacity, someone has to be able to sign for you. So we recommend anybody above the age of 60 has an enduring power of attorney. And again, when you're getting your will written up through your solicitor, they would do all that for you. So the other thing as well, again, not really quantifiable in a spreadsheet as such, but this is just based on my experience, okay? So when somebody passes away and their affairs go into probate, it can be very, very messy, okay? So the first thing is to make sure that if you're married, to try and put as many accounts as possible into joint names so that if something happens to you, if you die, it doesn't get locked up in probate and ultimately the surviving spouse can continue to operate the account. A lot of people, you know, maybe above 60 or 65 would have legacy share certificates, the paper-based share certificates. Just get them into nominee form as our advice, get them digital as such, so that they're not there and you don't have to, especially with old US share certificates, that's a separate conversation, but that's quite cumbersome and complex. So I suggest you get them into nominee form. If you have small unused bank accounts, should be closed or consolidated. I heard last week, one of the Irish banks has over 5,000 accounts in the queue in probate of accounts that need to be gone through manually in terms of releasing the funds as such. So if you've got 5,000 here and 10,000 there and all these miscellaneous old accounts going back to your student, being a student back in the day potentially, just clean them up and put them into somewhere in more consolidated accounts. Investment portfolios should be simplified. Again, a completely separate conversation, but and assets like properties with your title deeds, leases, all that type of thing. If you're in business of property or your own business, obviously make sure there's a succession plan there and somebody has access to all that. We're doing okay on time. We've got a minute before 40 minutes, so we'll have a couple of minutes for questions at the end. Summary, you need to take control. Always think long-term. As I said before to a client, when you come in to meet me, you're never going to be excited or leaving saying, well, wow, this is very exciting. He showed me a brochure that's going to give me instant returns and no risks. Most of the advice we give is, 10, 20 years plus away. So it's all about long-term, short-term pain for long-term gain. Giving up cash flow now for your long-term pension, giving up cash flow now for an education fund for your kids, all these types of things. I promise you, my retired clients thank me for it when I've done it for them 10 years ago. And that's what younger people on the call need to do. Think long-term. Always look at all your assets in holistically. Don't ever look at just your pension or just your investments or just your property or just the value of your business. Look at everything holistically in terms of pie chart. Be tax efficient. $3,000 a year small gift exemptions. Just do it if you have the capacity to do it. Maximize your pension contributions. Please do that. This month in particular, talk to us about that. Avoid unnecessary avoidable risks. Do not take leverage for an investment if you don't have to. Don't put all your money into one share or one sector. Don't let the heart rule the head. Okay, talk to us before you take any unnecessary risks. You can still get good returns over the long term by avoiding big risks. And always get professional advice. Just a bit about us, investment management, pensions, financial planning. We always put our client first. Our service is completely tailored to our client and we're proactive with our advice. And we always have a long-term investment time horizon. This is just our team. And just a reminder, we're signing up clients between now and the end of the year. We have a lot of very loyal clients and financial advisors and professional advisors on this call. We're open for business. We're happy to have an initial Zoom coffee, virtual coffee with any contacts, colleagues, family members of yours who you feel would benefit from having a conversation with myself or any of our team here in Compass Private Wealth. So thank you for attending. I really hope you enjoyed it. If I spoke too fast or my Cork accent was too strong or anything like that, I'll be sending out the recording afterwards. We've got a couple of questions in here. So one question here, Anonymous, is asking about the all the growing government debt and what's going to happen with inflation. That's definitely a factor, and that's a very good question. So because of all the quantitative easing and all the funds that have been boosted into through central banks, into businesses, into consumers, inflation comes about as a result of both the quantum of money out in the system, which we know there is significantly larger balance sheets now, but also the velocity of money running through an economy. At the moment, because we don't have inflation because people aren't spending as much because we're all afraid of COVID and businesses aren't open. But in time, say if we fast forward 12 months and let's assume that whenever we have a vaccine, people are going to go back spending and there's going to be more money out there. So there's definitely going to be inflation at some stage. So inflation has been around for thousands of years. It will happen. To mitigate inflation, if they believe the inflation rate is going to go above 2 or 3%, central banks and governments will increase interest rates back up towards 2 or 3%. So at the moment, anybody on a variable rate or a tracker rate loan is paying back very little at the moment, and thankfully that's been reduced because of the lack of inflation. But definitely inflation is going to be a big factor. So, you know, having your money in assets that are linked to inflation is very important. Just another question we have here is what do we expect from the budget next week? There's a rumour that the stamp duty on residential could go up from 1% to 2%. At the moment, it's 1% in the first million. That could happen. I don't see anything at the moment on pensions. I think that they'll be afraid to do too much in this budget because it's just too close to, politically, too close to everything that's happening with COVID. So I think that in terms of, there's a lot of things we as an industry would like to bring in terms of the group thresholds for inheritance tax coming up. I don't think that'll happen. We'd like to see the 41% exit tax on funds reduced. I don't think that'll happen. So I think from a personal financial planning point of view, there won't be too much in this budget. And one other question before we finish, last question is on Donald Trump. So look, I mean, and the risk ultimately, I woke up on Friday morning and when I saw the news that Trump and Melania had been diagnosed with coronavirus, I felt that, you know, having been very familiar with investment markets for a number of years, this was going to be significantly negative on Friday for stock markets. And when I looked at the US futures before Europe even opened, before 8 a.m. on Friday morning, the futures were only down about 1 or 1.5%. And actually in the 3 trading days since then, markets have kind of moved sideways. In fact, markets sold off last night by about 1.5% because Trump sent out a tweet on the stimulus package in the US that he subsequently kind of retracted, and futures are up now again. So it's quite incredible that the whole stock market and industry is always looking at Trump as, you know, what Trump says will move stock markets. And seemingly the biggest risk out there at the moment with COVID, combine that with Trump getting COVID, and somehow markets shrugged it off and didn't really care. So look, that's all we have time for. There's another couple of questions. I'll come back to those people individually. I really hope you enjoyed it. I appreciate your time. Thank you for tuning in. Reach out to us if you have any questions and we'll talk to you soon. Thank you very much.